So I can fire up the video too. Hopefully it doesn't slow me down. Slow the internet down sometimes. Is my volume all right? Okay. All right, so guys, I don't have any slides prepared. I'm not really doing this as a formal webinar. So if you have questions, I even have the YouTube chat up. So whatever you guys want to talk about. I mean, my background, I started, when I first started trading, options was the second instrument I learned. And when I was at Schwab, there's a team of only about 15 guys that trade for the entire firm. And when I was leaving, they wanted me to be on that team. They cover the hedge funds and everything. And that actually, it was because of options. Basically the only reason I passed the 7, because I didn't understand any of the debt. I didn't know anything about fixed income. I'm not a very good test taker. I didn't really study as well as I should have. But the options, I was trading options for, since college, probably, maybe even a little bit before. And so for me, you can make options really complicated. And I think the way that they teach it, if any of you guys ever try to learn the different strategies, they're going to teach you a visual that I've always thought's kind of, to me, it doesn't make sense visually. Like they'll start to show you the profit and break evens, and they'll draw these graphs like this. That'll show you time. They'll show you price, and at a certain point, you hit a break even, and then when you add in another leg, you can make it look like this, and you're gonna go like this, and then there's another break even. And to me, it was just always visually hard to kind of, for me, I'm visual. So when you start to add too many lines like that, I couldn't understand the strategy. So when I teach it, I just visualize it right from the charts. And so I kind of taught myself just how you would view price from low to high. And then time wise, it's kind of hard to draw time on a 2-dimensional chart, but or as far as when you're describing the options and where the break evens are. Another thing with the break evens, it's not really well put in the text, is this is kind of a confusion chart. When you're trying to figure out, okay, if I paid $2 for an option, it's going to be a little distracting because the market's still open. We still might test the lows today. I need a blank space. Let's see if I can do this. Wow, what do you mean they screwed you on the internet connections? What I was saying is that when you have, like, because since we're talking about, like, if you get on CNBC and it's like so-and-so's call makes money, you buy the option for $2, and obviously if the stock goes up, your break even is, if the stock's at 30, your break even is at 32. Well, actually, that's not true, because as soon as this moves off of 30, I could sell it into the secondary market for a profit. I don't have to go take this to expiration. So my break even isn't actually 32. My break even is literally right as soon as it moves past my commission. So just simple things like that that when you learn out of a book or you learn from a professor. I mean, I've took all the graduate level courses on capital markets, and our options teacher, we went through how to price options and all the Black-Scholes stuff, the formulas, calculating it, but then they can never teach you how to use the options to make any money. So they're not good about the real life application. And so you can make options really complicated, but that's not really how you want to use them. Simple is better. And then But once you guys get the model down, you can add the options around the model, and there's several strategies you can use, but it's usually the same one or two or three concepts. You're either selling, taking in money, and you can do different combinations of that, right? Or you're taking debits where you're paying and you're actually purchasing the option. But the times to do that is all based around, are you bullish or are you bearish? And so first you have to get the mark, first we talk about the direction. So if you're lost on the direction, you're going to be, you're going to be buying puts down here yesterday when S&Ps are on the low. Okay. When, if anything, if you were bullish, you would be selling puts, not buying puts down here. So you got to get the direction and the timing right. And then it's okay. What's the basic strategies that I want to use around my opinion on whatever it is I'm trading? And then maybe it's 2 or 3 strategies that you want to use around your position. And so as I teach you the core adding and reducing, you can also add in, as another layer of adding and reducing, you want to play options on top of that. So there's times where when you're getting more aggressive with your size, usually that's the point on the chart and the point within the cycle that you want to sell more upside calls, or you can be more aggressive with buying your ratio back spreads. So I guess it's kind of easier if we just get into some examples. Where's most everybody at on here? Is it options are brand new? Like how does a call work? I don't want to kind of get into too much of the basics because that's stuff you guys can learn on your own. But in the options course that I did a couple years ago, I basically teach you the parts of the model, again, to get the direction and the timing right. And then one of the main core directional strategies I like is called the ratio. It's a ratio back spread. All right. And that's probably one of the more complicated ones. And you never really hear about it, or not a lot of people use it, but it's one of the best. You minimal risk, and you have all the upside, and you can put it on for a quarter of what it would normally be if you just did a plain old put spread or call spread, or obviously if you're just outright long a call or a put. Know the basics. Okay. So there's a ratio back spread. That's probably the most complicated one I get into, but I start off with just teaching you about calls. All right. Calls and puts. That's kind of the first level I use. And then there's times to buy those, go long them, and there's times to short them, right? Or write them or sell them. And then you get into the spreads, which is usually it's the same directional thinking as when you want to outright buy calls or puts, but you put another leg on there to really take care of the time value, right? So the problem when you take a debit spread is you're taking on the time value risk, or the theta. So when you sell that other leg, you're going to at least you're selling some of that time value. It's like an ice cube. It's going to melt towards expiration. So you usually want to have some sort of spread on so you're getting back some of that time value, because even if you get the direction right, you're going to be losing. And then that third part is kind of getting into the ratio spreads. So maybe I can just kind of touch on this today. And I just wanted to maybe show some examples of when I used all 3 of these this week. So I'll try to see if I can hit on all 3 of these. I'm just winging this webinar. Okay, so why don't we use the VIX, for example? Well, we talked about Tesla too. Maybe we could do both. Well, let's do Tesla because that was probably the one that made the most money off of this month, even though UVXY is been pretty lucrative. Okay, so let's keep it basic and then I'll try to drill down. So hopefully all these signals here on the charts aren't misleading, but all I try to do, maybe for some of you that aren't really familiar with kind of our work, but I'm just trying to highlight, these aren't automatically generated. I literally have to put them on the chart myself, but I'm just trying to keep track for my own trading purposes, but then also to kind of signal for our traders what we're doing, where on the chart and when. Sometimes I'll put on here like this here. I was actually writing in the options. It's just really time consuming, and then it takes up so much space in the chart. But that would be really good if I could highlight on here an entire trade with the visuals. But here's an example where from a global macro view, last year we were still very much bullish on growth. This year is a completely different story. So coming into this year, we were looking for names to short, and Tesla has been one of our favorite ideas for fundamental reasons. A couple other things, but we don't really need to get into that. So the point is we have a bearish bias. And so using options, you don't get away from the model. You still want to trade when you're with the trend, with the cycle. And so this was the first place that I got involved here on the option side. I remember this was the tweet from Elon. I really wish I had done something. I was kind of away from the screens that day. But when you put on a trade, I don't like to just go outright the puts or the calls until I'm on a smaller time frame, and I know I'm at a spot where I want to get more aggressive. So just like guys, when we day trade, the core positions are a smaller size over a wider range of the chart, and then when you're day trading, you can get more aggressive. I treat outright calls and puts the same way, and I will buy like weeklies out this Friday or out next week. I'll buy inside of 2 weeks if it's a small time frame. When you get outside of like when you're swing trading or long-term trading, anything inside of 2 weeks, when you go long those contracts, you're really fighting the time value, the time decay. So timing the market's tough enough, but to give yourself only 2 weeks to be right, you're just setting yourself up for failure. So inside of 2 weeks, that's pretty valuable. That's something you want to always think about when you're trading, when you're buying calls and puts. Now, when you go, so swing trading and longer term trading investing, you need to be out really 3 to 6 months. 1 to 2 months is fine if you're rolling stuff. So when I start a position, I'm usually, if it's a longer term position, I'm not just going outright the puts. So in this example, if we're bearish, all right, I might put on 350 puts, and then maybe I'm going to write something out. Maybe if I buy this 2 to 3 months out, sorry, this pen gets a little bit crazy. If I buy something 2 to 3 months out, I'm usually going to write the downside call the same way. So I like to visualize it on the charts. If I buy 350, maybe I write something down at 250. It's out 3 months. Now, obviously, if you were trading inside of 2 weeks, maybe some people do, they buy their 350 puts, you're not going to get anything for a 250 strike put, right? It's just too close. Those aren't going to be worth anything. So when you're out 2 to 3 months, there might be something here at 250. Maybe you have to go at 300. But what I was, and then you can see we were starting to book some profits when the market moved down. But then here I put on another spread. So this was 315, and then I sold 290s. So this was an example of adding. So here I might have had the longer term spread, trying to catch a wider range of the chart, right? And then here, when we had a little bit of an intermediate term bounce, I can put on another spread on maybe a shorter time frame. Like maybe I might have only gone out a couple of weeks. I might have gone probably out a month. And I bought the 315s, and then I sold down here. So by the nature of when you put this spread on, my potential to make money is really kind of just in this zone. So in order to capture all of the move, that's why this is my core position. It's a little bit wider, right? So then I can capture, if we go through the 290 level, like down to here, I'm still making money and taking advantage of that. You guys kind of with me so far? And again, so I don't want to just buy the puts, because what if the market goes sideways like it did here for a week or so? I'm just losing all that time value. If I write the 250s or the 300s, let's just use 250 in this example. That same time that the market's gone sideways, I'm making money on my short leg, right? So I'm losing money on the one I'm long, but the one I'm short, say -1. If I'm long 2 puts, I'm short 1 down here. This one I'm short is getting less and less and less, so I'm making money as it's going this way. So the idea is that the short leg is kind of canceling out some of the time decay that I'm losing here. Now, another thing I like about usually always having another leg on or having a spread on is that this would be an example here. And I didn't do this, but I've been doing it a lot on UVXY, where you notice that price, you put it on here and then price backs up against you. Well, the nice thing about having the other side of the options on is you kind of have both sides of the market. So when it backs up against me, maybe all I want to do is take off this short leg. So as this comes back up, I think of it, visualize it like this. I'm short here, 250, price moves up. This is moving in my favor. I take profit on the short leg. And so you can kind of leg in and leg out around kind of the same way we add and reduce. So I don't necessarily have to buy any more puts here. Maybe I just take off some of my, let's say you were short 5 here or 6. So you're short 6. Well, as the market rallies, these are going to be increasing in value. So maybe I cover half of them and I buy back 3. So then I still have 3 contracts on that are working on the time value for me. But as I take 3 off, I book those gains. And then now I'm actually more short, right? Because I know it's kind of getting sloppy here. Erase. Click. So let's say you start out with going long. I usually long as a plus usually. So let's say you're long 10, and then you sell 5 down here at 250. Well, when the market rallies, let's say you buy back 3 of these, your net position just increased on the short side. So if you were long 10, you were short 5, you're what they call your delta would be net short 500 shares, just for example's sake. It's not exactly because the delta is moving as you're closer to the in the money or out of the money. But just to mentally get a feel for, am I increasing my short position? And the answer is yes, because you're long 10 or 1,000 shares, but you sold 5 contracts, you're short 500, so you're net short 500. Well, as the market rallies, if you buy back 3, right, now you're only short 2 down here. So your net position as you come up here is actually more like short 800 shares. So that's kind of a way of getting more short or adding. And what you could also do is then buy more puts. You could always do that, and you're adding to your position. But the key is the same thing as adding and reducing around the ebb and flow. And if you're just long or just short something and it gaps up or gaps down, you don't always have the opportunity to react. And, at least here, when I have both sides of the market, I can capitalize and realize some of this. I don't necessarily have to have the direction down so perfectly. So that's kind of a brief overview of why almost always have some sort of spread on. One, because it helps the time value, but the second is then I have the others at both sides of the market. So there's opportunity to do something either way, to make some money either way. Now you still have to manage your risk, because you're going to have risk on one way or the other. But the point is that the person that's just short and the market moves against them, they're just waiting for the market to come back. The person that has short puts or calls on can maybe realize those calls or puts, and then when the market comes back down, they've already capitalized on that move. Or the person that's just sitting and waiting is just, hasn't had the chance to do anything. Like today on UVXY, so if you just bought, because I had some short 55 calls that when this market dropped down this morning, I basically booked 80 or 90% of those, because those were moving in my favor. And now that the market's come all the way back up to 60, I could basically reshort those. So the person that's just playing the longer term move without having both sides of the market is basically in the same spot right now as they were earlier today, because maybe they're playing for a move to like 40 and they haven't done anything. Meanwhile, you could book gains, come back, reshort. You've taken advantage of this whole ebb and flow, whereas the person who's just net short, kind of just wasting their time, really. So there's a better way to compound. And then the call ratio spread, I'll kind of leave for the training, but just to give you a feel for the way that would work in this Tesla example, is instead of just buying like 315 puts and then selling the 290s, the put ratio spread is where you buy, let's say 330s, you're going to buy, let's say 30 contracts. All right. I'm going to go long 30. And then a higher strike, I'm going to sell a ratio of usually 1 to 2 or a third less. So I usually like to use a half. So if I'm long 30 puts, I'll short 15. I'm long 30, and I'll short 15. And because these are puts, so is the 350 put more expensive or less expensive than the 330s? Hopefully some of you guys aren't glossing over. So if you're bearish Tesla, the way this ratio back spread works is whatever direction you want the market to go, you're going to be long 2 times or basically 3 times the amount of those contracts. So I want this thing to go down, so I'm going to be long 30, 330s. And a 350 put is higher. It's going to be worth more. And so let's just say, for example, maybe these 30 puts are $10. And then these 350s might be 15. So it's a position where I'm not in trouble, where I'm not like naked short if the market were to really crash. So even though I'm selling, this is why you kind of have to walk you guys through this from the beginning in the options course, but because I'm selling the higher strike, a less amount of them, even though they're a higher amount. So I might bring in, what's 15 times 15? All right. So that would be, well, we don't even need to worry about the dollar amount. The point is, I'm buying. It's the smaller one is going to be worth less than the higher strike. So, I'm buying twice the amount. So to put this entire spread on, $10 times 30, 300, right? Oh, this is a different color. And then 15 times 15 was like 220. 220, 22.5. So I'm bringing in $225, and it's costing me $300. So basically, by writing these, if you're just to outright buy the puts, I mean, you're paying, here you're net $75. Here you're net 300. So this is what I mean. It's like 2-3 times less that you can basically control the same amount of options. So like if I put 30 on and I sell 15, I know that I'm basically net long about 15 as the 15 puts as the market moves in my favor. Well, just to go outright put 15 puts on is going to cost me more than doing this with a ratio back spread. And then the risk is kind of that the market at expiration were to close right in front of this strike, but the odds of that happening are really, if you're going to roll this or you're going to trade around it, the odds that you're just going to let it expire right at 349. But in theory, the risk is basically, because if the market trades, if Tesla were to gap up again, like here, this trade can actually make money depending on, well, if you put it on as a debit, you're going to lose whatever the spread is. But there's ways sometimes you can put these ratio back spreads on where you sell, what you sell is so much more in the money and expensive that you can actually sometimes put these on at a credit. But once you get above 350, that's basically whatever you pay in your debit, that's your entire risk. So if the market gaps up, the guy that's short the outright shares, he's going to lose all the way from 350 to 380, whatever that stock price is. But when I put the spread on, I know what my risk is. And my risk isn't even that entire amount, because if, again, let's say it costs us $75 to put this spread on. Well, that's assuming if I let it go to 0. Maybe if it backs up on me and I lose 50%, I sell it out and I take my loss. I'm only risking 35. It's probably an easier example when you don't use such big numbers. The call side might be a little bit easier. So like if you take a look at UVXY, Chris, on the ratio back spreads, yeah, you can mix and match them, but you just have to, your broker is just usually going to pick up on, if you, let's say, you know, if you buy a put only out 1 month, but then you try to sell like the 350s here and you go out 3 months, technically you're naked. You're naked short once this put expires 1 month from now, and you would just be short these 350s for the remaining 2 months. So your broker, even though maybe in your mind you're not going to get rid of this, or you're going to take care of this spread in a month's time, the broker will still say, hey, that's a naked short position. You can't do that based on your options approval, or it's going to tie up a bunch of your buying power because, do you know what I'm saying? So typically if you do the spread in the same vertical, the same months, you're not going to get messed around with that. Now, sometimes I'll sell the shorter, like maybe you just want to sell the weeklies, whatever you're going short. If you sell a shorter time frame, then you don't have to worry about being treated as a naked position. I think you get that. I was just going to say on the long side, you don't have to think about UVXY here directionally, since I've been kind of playing on the short side. But if this was a chart that we were bullish, guys, if I wanted to do a call ratio back spread on the upside, I would come in here and let's say this is where the market's trading, where our buy signal is. And so I might buy, just to keep it really simple, I might buy 2 calls at 52, and then maybe I sell one down here at 46. I sell 1 call, 46. All right. So if the market goes up, this is a very bullish position. And in theory, it's bullish to infinity. Because even though I'm short here, 1 call, which is a bearish, shorting call is a bearish for the most part. I'm long 2 higher strikes. So if this security goes to the moon, you know, I'm going to lose. I'm going to keep losing and losing and losing on this short call, right? Because somebody has the right to basically buy at 46. So I have to be short at 46. So 46 to infinity, I'm losing 100 shares worth, right? But I'm long 2 here. So even though I'm losing 100 shares, I'm winning on 200 shares to infinity. So that's why it's and then if the market, again, based on if you were to let whatever you paid for it into expiration, if you went out, let's say this is 2 months, and the stock just went sideways, well, that's, you know, you're going to lose whatever that debit is into your expiration. And the most you'll lose is if that's settled right in front of your 46 strike at 2 months. But that assumes that you're just going to let it expire. If you're trading this directionally, you're probably going to be either stopping when the chart takes out the low. So you'll probably only lose 50% of whatever you paid for this thing. You're not going to lose the full 100%. So I usually leg in and out of these call ratios also anyway. And just, I treat the call ratios like lots. And then the risk on the downside is you don't, once you paid your debit and the stock crashes, you can only lose as much as you pay. But I like that better, because if I pay 52 and then I short 46, I still have all the upside. A lot of people will just say, you'll hear on TV or whatever, I'm buying the 52 calls and I'm selling the 64s. Well, you put in a ceiling for yourself. With the call ratio spread, I got limited downside, but then I have all the upside. And selling these calls helps, again, alleviate some of the time decay. It brings down my cost. So it's still better than just outright buying the calls. You guys kind of see that one? And then so you can leg around that stuff too. Like if you were to buy the 52s and then the market kind of drops on you, say back to pi, well, I might want to buy more at pi, right? So whatever those short 46s, I'll just, I'll take my money on those 46s, book that, and then maybe I'll put another call ratio spread on. Or maybe I'll just buy more calls outright and play for like a couple weeks, bounce on some shorter time frame calls, something like that. And then if the market rallies off pi, you could always reshort your 46s. And so that's what I mean by it's the same adding and reducing. It gets fun, really. Trying to think of some more examples. So then, does anybody have any questions? That's as much as I really want to go in the call ratio spreads. You guys can learn more about it. The options course, I walk it through pretty, and I go through from kind of the basics to that call ratio spread. And then so, like on Tesla, there's times here in the short term that I will use like the weeklies. And that's just because I know that I'm going to have smaller cycles. I don't need to worry about, my option expiring worthless in 2 weeks. I'm probably going to be out in a day. Let's see if I can zoom out of here. And it kind of gets complicated, but there was a point here where I was putting on the longer dated puts, like 310, 325. I was long. And then when we had these big gaps down, what am I trying to say? Oh, some of these I did spreads on. So if I had bought, let's say, the 315s, and then I think I'm still short like a 275 right now. So I've even legged out of the long side of some of this stuff. So I booked the bigger gains, like the 315s. And then what you could do there too is start creating these spreads where, all right, I know we've had a big drop, so I know that the probability of a bounce back is higher. But obviously, if we go there's a lot of meat on the bone between 315 and where this price action was, right? So you want to book those gains. And then I don't want to just, as soon as we have a little bounce, I don't want to go back and rebuy 310 puts or 290 puts or 300 puts. I need to have a bigger bounce. So when we don't get the bigger bounce, I kind of roll down your thinking. So if you were long 315s and you sold, say, 280s, you're short. Well, when you get the move down, you book these. But then I don't want to just, let's just say that's all you did. You don't want to just get rid of your puts and you just stay short the 280s. Now you're in a long position, basically, because I'm short these 280 puts. So if the market keeps cratering, now you're basically put yourself in a long. That's against the view of you wanting to be short, right? So I don't want to go buy the more expensive puts because we haven't bounced enough. So what you can do is buy the cheaper, shorter dated puts like that are out of the money. So when we got this tiny bounce to here, I wasn't piling back into 300 strike puts. I bought the cheaper puts down here at like 250 or 240. And I can buy a lot more of those cheaper ones. And that the nice thing, you buy the cheaper ones and you buy the out of the money ones with the smaller deltas, that if the market does back up on me, I'm not going to lose that much on these puts. The ones that are cheaper, shorter duration, and out of the money, it'll be I'll be giving back less gains if the market bounces. And then I can put on the heavier delta put positions. And I buy back my 280s or my 295s or my 300. So like right now, I'm actually still short some 280s, I think 270s as a part of my older legs. But then I've got all these puts down here. And I got a greater amount of these that might not hit, but I'm still net short. I don't know. That might get a little bit complicated. I'm just trying to show you guys the feel for. And then so on the shorter dated stuff, like if you put a 3-month position on here, maybe you have another 3-month position on here, meaning you're out 3 months in time. If we get intraday, like sometimes we're trading, you guys know that we get like on the open and we come up to a big level. I think this was like 312 or 307 or something. A couple times we were playing this. Intraday, yeah, maybe it's a Monday and you go out to Friday and you buy the just the out of the money cheap puts, and then boom, the market sells off for the day and then you book your gains. I did that right there. And then meanwhile, you're letting your core position play out still. You're still in your 3-month position. Then there's another little short date options play there, boom. And you're still waiting for the bigger move to play out. I don't know. Are you guys liking this stuff? And you guys can treat these like ratio spreads just like a covered call or something. So if you have a net, or just in general, if you have a net position, so let's say between a couple core positions here that you're going out 3 months, let's say you're net short 10 contracts. Well, when you get to points in the cycle or you get to levels where you're really oversold or something, maybe you sell a put, kind of like a covered call, covered put, because you're short 10 contracts. So maybe you sell a couple of puts down here at 240 and you only go out a week and you collect the buck. And you do that every week when you get to the bottom of your cycle or the bottom of the range. You do the same thing on the long side, In our example, if you're long 2 and you were short 1 in your call ratio, you're really only net long 100. But let's just say this was 20 and this is 10. So now I'm net long, again, 10 contracts. So maybe I play with 2 or 3. When you get high within the range or something, then you sell like a 62 strike call. Sell 2 of them. and then the market sells off, and then you buy that call back, and maybe there's $1 there, or $2 there, and you make money on that. The market rallies again, you sell the 62s again. And if the market takes off through your 62 strike, that's okay, because you still have 10 that you're long. So it's just another way of kind of reducing your position. Yeah, and I'm probably making it more complicated just because I know it's kind of hard to follow. I guess the last thing I kind of wanted to touch on with the UVXY, or so the VIX, the overall call has been to be long volatility. So this would have been a great spot to buy, call ratio spreads. You can't do that on the VIX, but you could do it on like UVXY. Let's just say you started doing the call ratio spreads too, like here, and you're a little bit early. So you were long 10 calls and short 5. These are calls. When the market drifts down on you here, maybe then you put another 10 by 5 on. And then the market drifts on you again, right? Mostly because of decay. If you're putting these on in lots, maybe at this point here, I book the short side of these calls and I take those off, right? So I book those gains when the market's down here. And now I've gotten rid of that short leg. So I visualize it like this. So now, and if you go out, let's say 4 months on these initially. So now I'm just long 10 calls up here at whatever this level is. Let's say, I guess it's 41, let's call it. All right, the market drifts down. So now I'm still long this tranche. All right, and then the market, let's say market really, boom, gaps down here. I buy another ratio spread, another 10 by 5. All right, and then maybe so I kind of do it like the first move down, maybe I'll take some calls off, the short leg. A lot of times I kind of like wait for the second layer down. So like this is the first wave down. I only have one tranche on. I get another tranche on. All right, the second wave down, now I'm booking that gain. Well, this is 1, 2 from when I bought this one. 1, 2, then I take that short one off. All right, so now I got rid of those. I got rid of that leg. Now I have another 10 contracts sitting right here. And then let's say you picked up the low right here. So how many are you long, guys, total, right? You're long 10, 10, and 5, right? Because you're long 10 and you're still short these 5. So look what happens though. So now you realize money on the way down. The guy that just buys and holds doesn't book anything, doesn't get to take advantage of what the market's giving you on the way down. You got to squat before you leap. So you booked gains here and here. And now when the market turns, guess what? You're getting in the money on these 39s, then you're in the money on these 41s. You've got 500 shares down here on the lows. And that's kind of how you catch the turn. And then on the way up, you can get more aggressive. Like here was a great place to buy. Maybe you just buy outright calls there, and then you sell them into the high right there. Then maybe you get another pull back here, and maybe you just put it, you keep your core position. Maybe you want to keep 5 to 10 contracts as your core position, right? Because maybe by the time you're here, you want to come out of these guys. So maybe you book those gains. But if you're trying to keep like a 5 to 10 core position, and then you get a pullback from here, maybe then I just buy a spread in addition to my core. Then maybe I buy 40 strikes and I sell 46s. Anyway, that would be the long side. And then I kind of do the same thing up here, big picture, out further when the market really gets stretched. Then I start doing the opposite. So when we're up here at pi, now I start saying, all right, maybe I'll sell some calls and I'll start paying, 55 strike put, doing a ratio spread 60 by 50. And the idea is 3 to 6 months from now, maybe this is back down in the 40s. This can happen quick too. Like, it doesn't take much of a rally for this thing to really retrace. Can't really get a good weekly chart. But anyway, so my thinking from here is either we're going to get a temporary low, which I kind of want to use pi guys around this. We'll bring it back to the markets and we'll wrap up. So directionally, this 4 hour, where we held yesterday was pretty big. So again, while everybody that just uses a moving average is thinking that this is bearish, being below the 200, our model's got this as the pivot. So unless we break here, I think there is a good chance we could snap back next week. You could have a bigger snapback rally. If that's the case, we're going to make money on these puts. Now, if this can't hold here, then you're probably going to see another double on the VIX. And so this is probably going to go something crazy. Like you could go to the 1090. Who knows? You could even go 110, 120. That's what happened here. Is you had 2 doubles. So if you get through here, you got to play defense if you're trying to set up a core short longer term. And then you can get more aggressive on the long side. And then we'll start to, just like I kind of showed the example of feeding into, I'll do it in orange, feeding into these longs, those tranches. Going to do the same thing. Well, I already started doing it a little bit here. All right, for the longer term move back down. But I also realize that if this is kind of our fence, our line in the sand, you got these lows too, which matter. That might be where the market holds. But we might have to cover or hedge or stop on some of these tranches, or just get really aggressive on the calls so that you make way more on the calls on the way up. And then I want to tranche it again, like something like this. If we get a chance, guys, to short UVXY, like anywhere in this zone, it's going to be like shorting here and shorting here. I mean, you had numbers out of 100. I know this thing was been reverse split or whatever, but the ratio should be about the same. I mean, you're going to get massive opportunity for this to go a lot lower from those types of levels. Chris, on the short leg, Well, you mean on the ratio spread? Because you need to have more, whatever you're long, whatever the direction you're playing, you need to have more of those so you don't put yourself in a short position. So real simply, I've got so much on this UVXY chart. It's probably so. Let's say you were playing Amazon bearish. You can't. Well, let me explain the call side first, because that's a little bit, our brains kind of understand that a little bit easier. So this is SPY. Let's just say, doesn't matter the time frame. This is just, let's just say we want to be bullish here at 270. So if I buy 10 contracts here, and then what happens if I short 30 calls? These are calls, right? These are both calls. If I'm long 10 and then I short 30 at 260, what happens if this thing goes to a new high? You're net short, right? You're long 10, you're short 30. Uh-oh, you're actually, now you're in a short position. So you can't do that. I mean, you can do that, but you're playing it the other way. So whatever I'm selling, if I'm selling calls, that's a short or a bearish bet, basically. So I got to be short less than I'm going to be long at 270. So typically you do it in a 3-to-1 or 2-to-1 ratio. So you could sell 3 if you want to be more aggressive, or you could sell 5. Make sense? And it's just the opposite on the put side. So if you visualize, if you're bullish, you visualize the tranche, I need to have more here. I need to be +2 to -1, or +4 to -2, or, follow? Because we want to make sure that we have enough shares that we're long if this thing rallies, because we're bullish. So that's why it's a back. It's a back ratio. You're selling the ones back behind it. Good question. All right, guys. Well, I know some of you, like Christine, you said you need options are new to you. I was thinking, we didn't have a lot of time to put this on the site. We're always making changes. Let me see if Alec had a chance. I'm so busy. But I was thinking, guys, for those of you that are new that want to learn, because I teach the options how I think you should visualize it on the chart. It's a much easier way to learn it than just trying to read the book again with like all the break evens, and it's like you're like, I just need to see it. How am I going to apply this in real life and real market, real time, to be able to take advantage of it? And if you guys are brand new and you want to learn the options, I also teach a good portion of the model in this course. I don't know if we've got it on here or not. Oh man, Alex, awesome. So just the course. Oh, I got to share the screen. Sorry. just the course is the model. This is an amazing value, right? $2,000, just the course in itself. It's 9 hours, everything institutional, analysis, execution, risk, psychology of trading. You got to be able to put it all together. It's not just about a couple indicators. It's not about risk reward and you need to risk $1 and you want to make 3. It doesn't work. We're going to buy here. We're going to set a target. And then the market moves just up to your target and fails. And you one step forward, one step back, one step forward, one step back, 2 steps forward, 2 steps back. You got to trade like a real professional does. You take a position, you add to it, you reduce. All right. There's a time you want the market to pull back so you can get more aggressive. There's ways you need to do that. People think that's averaging in. That's a bad thing. It's not. You got to know where you're wrong. You have to be able to put that all together. So we do that in the course. That's just the model. But then with the options course, you get that. And I'm going to go through with, calls and puts, spreads, when to use them, covered calls, how to generate income. If you're long stock in your 401k, you can rent your stock out every week. You could buy a $500,000 house, and maybe if you rent it out well, after expenses, some maintenance, maybe you get $300 a month in passive income. You could take a $500,000 position on Google and you learn these options, and you could write $1,000 a week on covered calls on your stock at least. I mean, a $500,000 Google position is huge. If you use a call ratio back spread, you could control the same amount of $500,000 at Google for probably $5,000, and you could write the same amount of income against your position. You take $5,000 and you're generating $1,000 a month against your position. I mean, what's a better return? So I teach that stuff in the options course. And for some of you like Chris, that you guys have been with me for a while, you've done the coaching. If you want to do the options thing, just let me know and I'll do it for $500 since you don't need to learn the course. You don't need to learn the model. But if you guys are new, it's great because you get both. You get the model and the course. And the options course. I think that's pretty much all I really wanted to hit on. But what I like about, I really would just encourage you guys, if you're to do the options. I mean, I've spent probably $10,000 and $5,000 learning options on different DVDs. One of them was like Business Week. And I still remember watching it in my sophomore I had a crappy room that had it was like in the attic of one of our houses. There was 5 guys and I had a slanted roof that came down, and I would sit in the chair with the kink in my neck watching the options video, just trying to learn simple stuff, debit spreads, credit spreads. And these guys they didn't teach anything direction. They were just talking about like a 20 period moving average and the MACD. And then I think I paid like $7,000 for 5 DVDs on that. But that's just where you start. So for this price, you're going to get really 100 times more value. But I just encourage you to add the option stuff to your tool belt, because when you get the volatility like this, there's so much back and forth that sometimes you want to, if you're just playing stock, you can only trade 1, 2, 3 stocks because it takes so much of your buying power. When you start using the spreads, I mean, like on one of my accounts, I think I have like $60,000 in cash, but I have like 40 positions because I've offset everything with a credit spread. It's somewhere in the leg that pays basically for me to get into that position. So you can get in and control a lot of shares or a lot of stock for 1/10 of what you would if you're just outright a stock trader or just outright. And then you guys can do the same thing around Forex and futures. You start trading the options around your futures positions. But so it's the big moves back and forth where you get oversold, you buy some cheap out of the money calls up near a 30, where a 30 period moving average is, or back where pi is, and then 2 weeks later you come all the way back and you tag it, or a week later you come all the way back, or a day later and you hit it. I mean, you get 300-400% gains really quick when the market's just so much back and forth. And then, like Santiago has us putting on the charts now, you get the volatility rises. So you get these options, you're getting a lot more for them when you're selling them. When you're right and something explodes, like you get some out of the money calls and the market moves and you're right and volatility explodes, especially on the short side when you have puts. Like the other day, we were trading like here. I forget who asked me, like, Jason, have you shorted futures yet? We had just broken like right here. And I was like, no, just because we've came so far so fast, I need a bounce before I want to start shorting futures and tying up my buying power and having a high delta. But all right, maybe I'll buy some puts down at 200, and that's what I did. And I didn't expect us to get there in that one day, but I think that was like 500% gain. So instead of coming in here, let me try if I can zoom in and show you guys. I'll just go to the futures. So you see 270, that was the low basically. Okay. So the other day, this is what's great about options is it's tough to want to short futures when you've had a big move, right? Like I teach you guys, if you drop from here to a new low, it's not the best time to be shorting. You've fallen from a high level into a new low. Typically, we want to be covering, taking profits in a new low. So really tough to start a future short that has a high delta, meaning that you can kind of learn about the delta, but let's just say it has a delta of 1 or 100, depending on how you think about it. For every dollar that I'm short one contract here, if this starts to rally on me, I'm losing dollar for dollar, right? You guys get that, right? If you're short 100 shares and the thing starts to come back on you, for every dollar or point that it moves against you, you're losing that same amount, right? Well, if something's really oversold, that's what I said in the chat, was like, just go buy these 270, 2,700 puts, maybe. Maybe you get there in a couple of days. And then that way, those 2,700 puts, well, let's just say they're 50 cents. And the delta is maybe like 10 cents. So that way, if the probability is the market does bounce, I'm not losing dollar for dollar, point for point. I'm only losing 10 cents for every point the market rallies. Then I'll short my futures up here, something like that. Then I'll get where I should be, I'll get more short delta. But if you don't get the bounce, guess what? By the time we hit 270, these 10 cent delta is going to go to 50 cent, maybe. Typically, an at the money is about 50 delta, right? And so this is a huge. This might be 33, 4, 500% gain, and you don't have nearly as much risk. So that's what I mean by you got to kind of at some point you need to add the options to your trading because some people are so confused here. Like, oh, should I don't know. I want to be short. I don't have a short position. The market's rolling over. I've been bearish for 2 months. I'll just wait for a bounce, and then you don't get the bounce. And they're going crazy at 2,700 because they missed this whole move. So that's why my initial reaction is, well, I know it's maybe if anything, you sell it small and then you want the bounce and short more futures, or just buy the puts. That way, if you go down, you're going to have you're going to have a huge gain percentage wise. And if it does bounce, it's not going to sting that much. And then you can short the better levels. You just got to start thinking with that optionality, and it kind of alleviates all the anxiety of, Am I all in or am I all out? And I didn't switch over the charts that whole time. Well, if you kind of try to visualize it, this is what it looked like. I was just talking about this move here. You're falling from here to here. All right. Yeah, you could short. Should I short the futures here? I don't know. We just had a big fall from a high to a low. It's tough. Why don't you just go buy the 2,700 puts? Maybe those are 10 cents. Hopefully you guys could see me drawing before. And then the market bounces. Oh, okay, great. Now I get to sell more. But if it doesn't bounce, at least you're in the game with these puts down here. And so this delta on these puts might be 10 cents. And then if it does, you do get close to those puts, I mean, these things will really explode. Like these puts will go through the roof. And you can use the reverse on the way up. Like yesterday, after we bounced, today you come in and it's kind of a weak bounce. Like when you have this much volatility, the top of the range can be all the way back here, like 2840, 2820, 2800. So this wasn't necessarily too big of a bounce that maybe you want to get back short, too aggressive. So maybe you sell upside calls here at the levels that you want to be short your futures. You get the bounce, you don't short any futures, maybe you sell 28-20 calls. Or you sell a call spread so you're not naked in case, I don't know. It's tough to have an index gap up. But that's kind of the ideal, you know. Sell a few calls if the market rallies. Okay, now I buy my puts. Now I short my futures. If I don't get the rally, at least I make something on my short calls, or if the market goes sideways in like the rest of the day, take advantage of the time decay. All right. Guys driving into Chicago, listening to us. I like it. Very good city. We're going to be there next weekend. Marius is going to be there most of next week. Sorry you guys had to sit through that without the chart. But I think you guys, did you follow me? I think you followed. All right, Chris. Since we don't, can you just message me, or I'll have Alec or Ritas follow up with you. I'll just send you an invoice or whatever. But that's awesome. Thank you. I'm excited. I think you're gonna do good on this stuff. Because once you guys like Christine's got the model down, I mean, her consistency is through the roof. And then when you start adding these options around that stuff, because there's times in the market where you don't get the area you want, and that's a good time to use the options. Like today, like I was just saying, this bounce is not that whole lot to do right here. 2,800 was better for sure. So, you know, you just sell some calls maybe out today or next week. And then you probably could have covered those today, this morning, or this afternoon, I mean. And see if you sell it like I wouldn't be just naked short at this low level at 2,800. Like let's say you sold 3 option contracts. I wouldn't be just naked short those because I know that the volatility is really widened out. There's a good chance that you could be up at 2860 again. You know, this is how these markets are going to start trading when the fall is this crazy. So you don't want to be just net short, but probably a good way to do that would have been to sell like 3 at this strike and then go buy 3 up here. So that if you did get that move back, you're going to be losing on this, but then you could take your profit on these, book that, and then you start shorting futures, or then you go into a put spread, and now you put on more. You put on like 28.50 puts, and then you sell the 270s or 2700s. That's another good example of having both sides. Like, just to sell the threes, you're probably going to just have to take your loss on that. I'd rather, at least if you have something up here, you're getting, it takes the sting off, especially since these would be so cheap that by the time you get up here, those have really gone up a lot. And then you start shorting more. All right, well, I hope you guys got some value out of that. 30 minutes till the close. I'm just going to make sure my book's kind of where I want it. And then guys have a good weekend. Maybe we'll go through some more of this stuff next week. And then just let me know, for those of you that are on the team, if you want to do the options course, and I give you that better price, since some of you are obviously already been through the model training. All right, Santiago, later, man. Is that Brendan? Brendan? All right, Chris, later. Have a great weekend. All right. All right, you guys be good. I'll talk to you. Thanks, buddy. You too.